Good afternoon. My name is Shannon Williams. I'm the CEO of the Home Furnishings Association. And today's webinar, we are going to be talking, this is a two-part webinar. We're going to be talking about achieving financial stability and cash flow. And today we're going to talk a little bit more about how to navigate some of these economic fluctuations, how to maybe reduce some of these cash flow challenges we've been hearing about, and also understanding just some KPIs and metrics that might be needed to help create a more efficient business structure. All of our webinars are recorded and available on demand, so you can go ahead and peek back at this later this week at myhfa.org/webinar. If you have any questions at all during this, and I would assume we have some, go ahead and hit that chat button on the bottom of the screen, and we will get to as many questions as time allows. We'd like to start by thanking Synchrony, who is our educational thought leadership sponsor. And want to start actually by introducing our panel of experts. First, we have Ronnie Ben Simon, who has spent 44 years with Giordans down in Southern California, which is a 10-store retailer, and 90% of their business was driven through in-house credit. He is now the president of Infinity Advantage, which are the creators of Infinity X expert retail and finance software. We also have Dan Jablins, who is the president of Retail Smart Guys, the retailer consulting firm that helps independent retailers improve cash flow by transforming business data into information that retailers need to make better purchasing decisions, maintaining a more positive cash flow, and generating more profit. And we have Jamie Winter, who is the co-owner of Furniture Mall of Kansas and also the founder of Tools to Win. He's a third-generation retailer who joined the family business back in 2009 after 16 years in auto electronic manufacturing. His experience in broad range price point retailership helped guide his development of Tools to Win, which is a tool that turns point of sale data into actionable information for the furniture industry. So, gentlemen, welcome. Super happy to have you here. So let's start this off with the elephant in the room. Economic times are hard, cash flow's tight. Dan, can you start us off by helping our retailers better understand what are some of the fundamentals of maintaining a healthy cash flow?
Well, let's start with this first basic thing. When you look at any retail business, and we work with retailers across the country and internationally, but it doesn't matter where you are. And it doesn't matter what sector of retail we're talking about. Inventory is their biggest expense. They spend more money on inventory than anything else, more than rent, more than people, more than technology, more than anything else. And so manicuring and curating that assortment is the key to proper cash flow. And I can tell you that I can summate what I do almost every single day into one term, which is how quickly you turn over the inventory. If they're turning the inventory too slowly, that means they're going to have too much money tied up in inventory, and they've got to make sure that they get that, figure out where they've got dead inventory, get out of those goods, whatever it takes. I always say inventory is neither wine nor cheese and doesn't get better with age, right? So the thing that we have to be cautious of in terms of inventory is if you've got stuff sitting around, you have cash tied up in that, and freeing up that cash and getting the inventory to turn better and faster is the key. And especially true, I started Retail Smart Guys. I'll just say this last thing and I'll turn it over to the guys. When I started Retail Smart Guys, it was in 2007. I started the company, and then a couple of weeks later, Saks went 75% off, and I thought I'll be homeless in about 3 weeks. What I discovered is that doesn't matter what happens in the economy, right? If you're turning the goods properly, that means you're getting the goods in, getting them out, getting them in, getting them out, and budgeting your sales and budgeting your inventory properly. If you're turning it properly, then you will have cash flow. If you don't turn it properly, or if you're having cash flow issues, the first place to look at is how do you turn your inventory?
That's great insight. Ronnie, Jamie, do you have anything to add to that?
Sure. I completely agree with what Dan's saying, and I kind of look at it like you need to prioritize what you're gonna hit. And usually, the three of the largest expenses that a retailer is going to have is going to be his inventory, his labor, and their marketing. The nice thing about inventory, it's the easiest one to convert into cash quickly. The other ones take a lot of work. It can be done, but it's going to take time. So you're right. I mean, I can't tell you how many warehouses I've walked into, and the first thing I look for is, okay, where's that graveyard? And they all have them. They're either in the back of the warehouse or in the shelves somewhere, but there's just junk that people just don't seem to see value there, or just never get to it. But those things can all be turned into cash.
Yeah, and I would say, I mean, obviously inventory is a huge piece of your cash flow and very important. But one of the things that's really challenging in this industry in the last few years is that we've all grown our inventory because consumers are demanding that they want a lot more things in stock. They're not willing to wait as longer. So that's obviously put a strain on cash flow because we're all struggling with higher inventory rates. And so that really brings the key to cash flow or improving your cash flow is really, how can we collect cash faster and pay it out slower? I mean, that's the key to growing your cash flow. You've got to either collect faster or figure out a way to pay it out slower is the only way you can grow.
And I think you have to, if I would just add to that, because I think it's a super important point, but I think the other part also is, if you don't get some really good proper demand forecasting is one thing. And so that you actually can anticipate that in a world where we've all beefed up inventories because of supplier issues, because of post pandemic issues and stuff like that. But demand forecasting is so critical to that, to make that work and make sure that you're out of that. And also, to the point of like walking the graveyards and the warehouse, I've walked warehouses and I go, some of these guys have had goods since the Carter administration. I think, at that point, it's not about preserving margin. It's about getting your cash out of it and getting it into something that's viable and makes sense.
Should retailers consider even doing it? I mean, I've seen retail stores do it at a loss. Is that important to collecting money and moving on and replacing something on the floor?
Bluntly, yes.
Yes, if it gets to that point, absolutely. You're collecting nothing if it's sitting on the floor in the warehouse and not selling. And it's interesting how people seem to fall in love with their merchandise sometimes and just don't want to take that extra hit. But every month it's sitting there, it's every month that it's costing you cash. If they take a look at their inventory as just piles of cash instead, if there was piles of cash sitting in the warehouse, they'd be running like crazy to do something with it. And they're not doing that right now. We'll get to it.
How can
Yeah, one of the things I think that makes that more difficult right now is that many retailers are still sitting on their COVID mistakes, that they overbought and bought product in. It was much more expensive than it is today. And now how do they get rid of it? And, at this point, man, unfortunately, you're going to have to bite the bullet and take a loss or take a very short margin to get rid of it, turn it into cash. Because everything that's just sitting there is just, it's wasting money. It's just sitting there deteriorating and not generating cash for your money and taking up space in your warehouse. And there's you can use it as a tool to really drive traffic right now, as a lot of retailers are struggling with traffic. So take some of those overbots and that COVID merchandise that you still got and, burn it in your ads. Make it to where it's so aggressively priced. You got to get rid of it anyways. That you're going to take a lower margin hit, but hopefully at least you can drive some traffic in the store and hopefully, get them to buy more than just your loss leader.
I would add two things to that. First off, if you've got something that's been there for a year, you have money tied up in that, right? What makes you think that someone, if they didn't buy it over the last year, why are they going to buy it now? What makes it so special now? I always tell people there's four things that are bad about old inventory. Number one is you've got cash tied up in it. So if you've got cash flow issues, that's a problem. Number two is that affects your marketing. If your customer comes in this month and sees what they saw last month, they're never coming again. Number three, it's hard for you personally to look at it, right? And even if I came in and I looked at the thing, I thought that was great. Imagine the energy you'd have to summon to get me excited about it. And when you yourself are so sick of looking at it. And probably the fourth thing that's the most devastating, and you need to check this with your CPA because it's different on a state by state level, but you're also paying tax on that inventory because it affects your cost of goods sold. So if it wasn't enough that you've got cash tied up in it, it affects your marketing, it's hard to look at, you're also paying tax on that old inventory. And I think also, as Jamie makes a great point about, put together some kind of ad or some kind of thing that gets you out of those goods. I often tell people when they're composing those kinds of things to also think about when they do that, when someone does come in, what can I sell at full price to pay for the markdown I had to take on the old goods? Right. So what can when they come, if they're going to come in for these coffee tables that I've had since the beginning of time, what can I add on? Or how can I bundle it in such a way that I pay for that markdown by getting some full price stuff out of things that I'm not so over inventoried on?
What
And
about?
I would add a fifth point on that one, and that's the opportunity cost. I mean, as far as I can
Yep.
see, most retailers have limited space on their floors. So if you've got, dead merchandise taking space, there could have been things there that were sellers. I mean, things you could have experimented with, things that could be generating cash flow rather than costing you cash flow.
What about some of these retailers who are selling custom, so their inventory is low? How is cash flow viewed from that perspective in their case?
Well, I think Jamie said that really well. It's about collecting it fast and paying it out slow. How do you, what's your policies and procedures by which you do that, right? The custom business can be a super profitable business, but I would also want to check your margins on that too. And make sure that you've got the proper margins on that, but also what are the policies and procedures by which if I come in and I say, I want this couch, but I want it to be 8 feet long, not the 6 feet one that you've got in the store. Are you taking the full money up front, or how are you doing that? How are you arranging to make sure that happens? Are you setting the right expectations for the customer? And have you set the right expectations with the vendor in terms of how you're going to get sold through on that?
And I would say that, there's a lot of interesting things in this industry that, just slow to adapt change on some aspects, but very fast on others. But one of the things that I see, I meet with retailers all the time, that, they're still allowing CODs on delivery. And, they're not collecting up front. And, the number one way to grow your cash flow immediately for most retailers that are probably listening to this cast is start collecting 100% payment up front, especially on special orders and even in stock items. That, man, if you can collect 100% up front, you are basically borrowing from your customer at 0% interest. I mean, it's the best loan you can get. And you're locking the customer into finalizing the purchase as well. So we changed to 100% upfront almost 15 years ago. And are there exceptions? Yeah, there's a few exceptions with companies and so forth that buy furniture and they have to provide an invoice and so forth. But we're about 98% collected upfront. And that has made a huge change in our balance sheet and huge change in our available cash flow. And, most retailers, you talk to them that are still doing CODs or still doing 25% down payments, they think, man, how could I possibly do that? Our customer will never pay that. And it's not that difficult. I mean, you try to go to any other retailer, you go to Home Depot, you go to Lowe's, you go order your refrigerator, your cabinets. No way are they going to special order that for you without 100% payment up front. But this industry has just been slow to adapt that. But it can be, as simple as, just changing your language and working with your sales staff to say, instead of saying, how much would you like to put down today? It's just changing that to how would you like to pay for that today? We accept cash, check, or credit card. That simple change, you'll get 100% upfront payment on most people without even doing anything other than asking the question correctly.
Especially if they're custom, right? And I think the other thing they got to
Yes.
look at is what's the merchandise mix in the store. I mean, if too much of the business is dependent upon custom, and that becomes a difficult thing, what's the grab and go stuff that they've got that's around there that actually can help also generate cash flow while we're waiting for the custom things to happen and get built and all of that.
And Jamie, I would add on, we did the same thing at my former at Dearden's in the 80s. We had a huge fight from the salespeople and the managers, or we're going to lose so many sales if we don't do COD. And I can probably count on one hand the amount of sales that didn't go through because of it. And it was also great not having our truck drivers out there driving around, some tough parts of the city with thousands of dollars in their pocket.
Yeah, and not only is it a huge increase to your cash flow, but it's also a cost savings. You look at how many people and how much time you're spending managing all those ARs and making phone calls, and you're getting ready to do delivery. Did they pay for it? Did they not? All that time spent on that. If you collect it up front, you don't have any of that expense. It's gone.
What about retailers who are using third-party finance and they don't actually collect money until the product gets delivered, and then that's when they're forcing their financing? How should they be considering this? Obviously, delivering faster plays a huge role. But what should they be thinking about in terms of collecting faster when when it's essentially very similar to a COD?
I
So
think
one
it's
of the things that you can do is that, you can finance very simple to require a down payment to where you don't have to finance 100% of the purchase. It's a very easy explanation to your guests or to your customer that we are happy to finance the furniture, but I cannot finance the sales tax or the delivery fee. We need to have that paid up front, which is usually, 10 to 15%, depending on where you're at in the country for that. So at least you're not getting 100% from the finance company.
And like everything, it's claim from the third party finance companies as quickly as you can and get that cash as quickly as you can. Hopefully you have something built into your software that can help you track that and get the things in that are still outstanding.
Do you think it's ethical to fund the financing at the time of the sale versus delivery?
What do you mean
I
fund the
completely
financing?
do. It's especially, you're committing to the supplier or to the vendor for that furniture, then, I expect the customer to commit to purchase. So, if your finance company allows that, again, it's a huge opportunity to grow your cash flow, to collect at the time of sale instead of time of delivery. Not every finance company will allow you to do that, but if it is allowed, I would sure look at it. We do that, as well as I know many retailers that are also pre-funding for financing. That works very well. You got to have your language right and you got to have your signatures right, but it is definitely possible and usually not a big issue.
So earlier you mentioned, there's 3 ways to do, inventory turnover. You're looking at labor, inventory turnover, and marketing. How does a retailer need to be thinking differently during economic times that they might think different than they would when the eating's good?
I guess I'd say this. First off, to me, there's 3, but there's a close tie there between marketing and rent for some of them. But I think first off, you have to know what those numbers are, right? You have to look at you have to be brave enough to crack open that profit and loss statement and really make it a workable tool so that you understand that. I think that when we talk about labor, you have to separate selling labor from backroom labor and management labor, right? And selling cost is a critical piece of that, because that's mostly where I see these guys bleed cash, is that they've got to really look at that and look at how they're compensating people. And I'm, I know it's a controversial subject, but I'm a much bigger fan of compensating people based on their performance. I'm a big fan of commission plans and incentive plans, much more than just straight salary. And during the really the roughest times that we saw in terms of the economics, both with regard to COVID and also when the recession happened in 2007, having an incentivized pay plan put everybody's skin in the game and made it a viable enterprise and made it work, and also makes it work on the other end too. I want to reward the people that are really selling well for us and doing that, but you have to break out selling costs separately from the others, I think. And when you look at the marketing costs of these things, there's a million people out there now that offer, search engine optimization and ad spend and optimizing that kind of stuff. My usual comment when I'm talking to them on behalf of any of my retailers, I go, listen, because most of these guys come from a world where there is no cost of goods sold. And so they just think if I bill you $1,000 a month and you get $1,500 more in sales, it's great. I have to convince these guys that if you bill us $1,000 a month and you get us $1,500 in sales, we lost money. Most of them look at you then like if you ask your dog to do the laundry, they kind of, that kind of thing, right? So I think you have to be prepared in that instance to understand that the return on ad spend or the SEO, that kind of stuff, you have to make sure that you've shared with them what your cost of goods is, so they understand what winning is when you use those services, to make sure that makes sense.
Sure. So to tag on the selling side, and I agree. I would always pay some kind of incentive based, and The retailers that I see that seem to be operating more in sync with the sales are operating more in sync with what management wants are retailers that are paying on profit, commission on profit, rather than just on the total sales. Almost everybody that we've seen that switched over to that will see their margin increase almost immediately. As well as measuring such things as attachment rates for furniture protection, for accessorizing, for bundling products. Those things, if you're measuring those things and you're coaching your salespeople on them, you will see some fairly drastic moves upwards in some of the more higher profit items that you can sell in your store.
Can you tell me more about like the psychology behind that? Why has commissioning on profit been more advantageous than commissioning on tickets on the ticket sale?
Sure. You've got to, and the people that I've seen, you give their salespeople an indicator of what the profit is on the items, and it's usually in the way we suggest they do it is to give it to them on the price tag, and it's usually some kind of a symbol, nothing that's obvious to anybody, but a red dot may mean that the profit on this is between 40 and 45%. A green dot maybe it's 45 to 50. And a different color for something above. So it kind of guides the salespeople along. And so it kind of helps them, move people. They know that they're going to get a higher commission if they can help step the people up to the better goods. It's also nice if you can cue your people, and it's not done as well, I'd say, in the furniture industry, because it's a unique product, but it works very well, let's say, in mattresses, is at the time of the sale, if you can pop for the salespersons something that's showing them, here's what you're selling, what you've entered, but here's better goods and here's step down goods. And you may need step down goods because somebody may not get approved for enough financing to buy the better product. And it works very well. And they've got everything at their hands. There's no reason that they can't make the decision or talk to the customer about that, rather than trying to keep it all in their head and figure it out, without a little help.
Some of the
Yeah, I would say obviously the incentives and kind of how you structure your pay plan can really identify and help focus your sales staff where you want them to focus. And if it's clearly, you want them to sell the highest margin item to every customer, then you can sure do that. And, we've got help retailers all over, and we have a few that, similar to what Ronnie was saying, we actually print and code the actual dollars of commission that the salesperson will earn if they sell this particular piece. So they can immediately see just by looking at a code on the tag, I know that I can get $50 if I sell this item, but if I sell this one over here, I'm only going to get 30. So make that very simple and make it very clear so they can push the right direction that you want them to.
Most point of sale programs that I've worked with actually have a way to sort of code the cost price on the tag also, so that if A is 1 and B is 2 and the thing costs me $12, it'll say AB on there, so they can actually see what the costs are and help them do that. The other thing I would say, and maybe it's not so prevalent in this industry as others, but sometimes people are afraid to do the commission thing. They're afraid that people are going to get bloodthirsty on the floor and they're not going to they won't work well together because they're all competing with each other and stuff like that. And I think that has to do with how you establish the culture of the store. My issue always with this thing is, if Ronnie and Jamie are both great salespeople, and I want a great salesperson on my floor, okay, and Ronnie and Jamie know, well, if I go to store X, I'm going to get a piece of the business because I'm going to be able to get some commission on it. But it doesn't happen in these other, it doesn't happen in my store. I'm not going to get Ronnie and Jamie because they're going to be excited to go someplace else. Part of getting the best salespeople for your store is offering a proper commission program where they all see that they can make money as a result of it. So I think, you might need some help in terms of structuring that and putting that together, and that's fine. But you want to put together a great commission program that your salespeople feel like they can make money and that they're excited about selling the product.
Something that I've seen in my past is retailers who use the feature that you've been talking about, Dan, where it can disclose some level of understanding of what the cost of that product is. One of the questions that came in during registration was really about markup strategy and where to cover overhead and cash flow and profit within that markup strategy. And I've seen that done to some degree where the visibility and transparency to the salesperson actually is a reduced margin at the point of sale that already covers the business operations. If you're a retailer, how would you go about considering markup strategies so that you were best positioned if you were maybe aiming to resell the business or extract the most profit out of the business?
We actually have a formula that does that, and maybe I'll let the other guys talk first, and I'll go look it up, so I can tell you what that is. But we put together a formula so that they know so that the buyers know what their initial markup has to be. Let me go grab that really quick.
I would say one of the things that is very typical in this industry is what we like to term marginitis, is that, you know, if you get the 55 points on an item or wherever you know is a little bit higher than what you normally sell items, people get nervous and think that that's probably too high priced, and so they lower the price. But what happens when you make improvements on your freight costs, or you get an unbelievable buy from a vendor at 30% off or 40% off? Do you really stay at that 55 points that you are happy with? And we definitely think not. But it plays with your mind of, if you see a 70% margin, you assume something is wrong. But instead, you really got a fantastic buy on that, and you deserve that extra margin. So a lot of times we will put cost in the system at the full normal price that we would pay a vendor, and then we take a cash discount equal to that significant discount we're getting from the vendor. So that way in the system, it's at full normal cost, just like we bought it for the last few years. But we know on the back end and on the P&L, it's going to show that significant discount that we actually paid as a cash discount in the system.
Yeah. Yeah, I would argue that, the rate the merchandise is moving at be distinguish what the margin should be. In other words, if you've got a hot seller, can you get an extra couple of points in margin on it? And Jamie, you're exactly right. I mean, I've had buyers before that they're just scared to death to take anything but the standard markup that they would be at, and we always try to have them start a little bit higher just to see, will it move beforehand. We can always bring it down, after we got it on the floor for a couple of weeks. But I think if you really let the product determine what the margin is going to be, you're going to be able to move that product up. One thing, we talked about the poor selling merchandise, but I think this is the margin here kind of leads us to also with the best selling merchandise, because one is a cash drain, the other one is just a cash generator, and I always feel that people tend to ignore them. They love to see them move, but what can you do to make sure that you have it? And to me, one of the biggest fails that we'll see at stores is that they'll run out of merchandise of a best seller, and the opportunity cost there is just huge. So I mean, we used to encourage our buyers, if they see hot sellers, and to always be a little over inventoried on that. And I know it's a short-term, cash out, but the long-term benefits are far greater than that, than having a little extra inventory on those hot sellers.
I found my little formula. Let me just throw that out here if I can. Okay. So there's a couple of numbers you need to know to do this formula, but let me just tell you what it is. The formula is you're going to take your expenses as a percentage of sales, right? If you look at your profit and loss and you look at the expenses below the line, not inventory, but expenses, rent, payroll, marketing, etc. Okay. You take your expenses plus your typical markdown percentage. So you got to look at what your markdowns were, plus your shrinkage percentage, plus the desired net profit of the business. So you take those four numbers, you divide that by 100 plus the markdown percentage, and that's going to give you the what your initial markup needs to be. And if you actually used all those numbers to come up with what that would be, you would have the room to mark it down, and you'd have the room to have the shrinkage and still cover your expenses, and still make it work. And if you guys want, I can afterwards, I can sort of, give that to you, and then you can send that to the rest of the gang. We can send that out to people. But it's a formula we use all the time so people understand what their initial markup needs to be.
That's valuable.
Okay.
Do you, if you were a retailer, how would you even recognize that there are cash flow issues?
Well, I
Well-
mean, a lot of times it becomes pretty obvious when you go to make your payroll check or your pay a vendor and there's no cash there, you're in deep trouble. And it's a lot of times it's pretty late in the game to figure that out. So really we can talk about cash flow management in terms of when you're struggling, but it's really difficult to make those changes, and you got to make something significantly different with, collecting faster or paying slower to immediately change that, like we talked about with collecting payment up front. But a lot of the cash flow management really has to start in advance. And you really need to look at, we like to look at months worth of expenses that you have. So really, we feel that if you have enough cash to cover 3 months of expenses, you're in a pretty good ballpark to be able to weather some storms. So imagine if your revenue completely shut off tomorrow and you continued with your expenses, do you have enough cash to cover 3 months before your revenue turns back on? And that's what we feel is really kind of a safe bet of how much cash you ought to have. And it can be cash or investments that you have, plus an available line of credit can also be configured in there to be able to weather that storm. But a lot of that planning has to happen in advance. You have to be ready for that.
Right.
I mean, it's just like your line of credit. When is the best time to ask for an increase in your line of credit?
When you don't
It's
need it.
not when you're in trouble. When you're in trouble, you go to the bank and ask for an increase in your line of credit and you provide all your financials. They're going to see the trouble you're in. They're not going to provide it. But if you're in a great financial position right now is the time to go ask for an increase in your line of credit, because that's the best time to get that insurance policy that you've got a little bit more cushion there to weather a larger storm in the future. But if you wait till the end where you're really in trouble, nobody wants to loan you any money.
What should the retailers who are actually in the hole right now be considering or doing? Is it cutting unnecessary expenses? Like, how can some of our retailers that are experiencing poor cash flow get out of that hole?
Well, the first thing is to look at old inventory. Without question. Well, I guess what my prescription that would be, first thing I would look at is old inventory. That's number one. I want to get my cash out of the goods that are laying around that have been there since forever, right? The second thing is I want to look at, I might look at if you've got some bad debt out there. There's a lot of people that got, either they have that merchant credit debt where which has been a disaster, or they have bad loans from point of sale companies or web companies where they do that. We've actually helped some people refinance some of those and get into better programs that make a little bit more sense. I think you have to look at your expense structure and make sure there's nothing crazy there. We also have helped some folks who credit card processing guys sometimes start you with a great teaser rate, and then they send you a merchant statement that cannot be read by humans, right? Because it's just purposefully complex. We work with a company that actually knows how to read those things and catches the credit card companies before they actually start increasing your rates on those. And I was working with someone yesterday, and his credit card rates were like at almost 5%. And it's because they started him at 2.75, and then over time there's a technology fee, there's a PCI compliance fee, there's a because I said so fee, there's all these fees that get added in. Next thing you know, they can't figure that out. And I guess the last piece I would look at is, revenue solves all problems, right? So what are you doing to generate revenue and generate sales in the store? What are you doing to actually outreach to customers? What are you doing to make it an interesting experience? Now we're looking at generation alpha, right? Which is the generation after generation Z. So I guess we're gonna go through the alphabet again. But both generation Z and generation alpha say the same thing, which is that they want to look at product online, but they want an in-store experience. They want the experience. So what are you doing to get people to come across the threshold? What are you doing to make it interesting? It's not just sale, because that's the worst thing. It's kind of like, what are you doing to have some interesting events in your store? Have some seminars in the store about buying furniture. Have some seminars about, you know, anything you want. But what's the event that you're doing to make things interesting to get people to come to the door? So it's partly looking at the old inventory, partly looking at your financial picture, and partly looking at what are you doing to generate sales and make things happen.
Right, and I just want to go kind of back to where, you know, once you're in it, it's a lot tougher to get out if you haven't you know, planned on it. And you know, I'll go back to my experience, and you know, we were always had great cash flow. We financed a lot of our accounts, and contrary to what most people might think, it's actually a great cash flow generator. Not at the beginning, but as you go through later on. And so we never really paid too much attention to looking at, you know, cash flow statements, because we were just kind of rolling along. And then 2008 hit, and the recession hit us, and all of a sudden everything changed. And we started then doing 13-week cash flow forecasts and monthly, you know, just a cash flow analysis, what came in and what went out. And I wish we would have had those things in place earlier, because we could have seen a lot more. I'm not sure how much it would have helped, but at least we could have gotten a jump on things a lot earlier than what we did.
For,
Well, yeah, but
for those retailers who don't do cash flow forecasting, do you have any resources or any good places to start for them to start doing a cash flow forecast on their own?
we give out a free cash flow planner.
You do.
Because we learned, especially during the pandemic, and then right after the pandemic, we had to have a very tightly, like Ronnie's suggesting, a 13-week cash flow plan that really takes into account everything in terms of the goods, your payroll, your rent, your all your incentive plans, what's coming due, that kind of stuff. Because if you look out and you go, oh my God, 9 weeks from now I run out of money,
Right.
you have a chance to fix that. I'm going to run an event. I'm going to run a sale. I'm going to talk to vendors. I'm going to, you know, I'm going to figure out, I'm going to get some financing, whatever it is that you think you need to do, you're going to need to do, but at least you see it. The worst is when people are blindsided by it. Oh my God, I woke up today and the bank is all over me, and I have no money and I don't know what I'm going to do.
Right.
Yeah, and we, you know, especially since, you know, we really started a daily cash flow analysis since COVID, you know, in 2020, we started the year with one of the most successful financial starts to a year ever. And then we immediately went to, man, we got to calculate how many weeks we can survive before we're bankrupt. And we took some of the lessons learned from that in terms of managing cash, and have a very simple cash flow statement that we put together every single day, so everybody knows exactly where we're at. And it's, you know, you take your bank account statement, your available line of credit that's left, you add those together, and you look at any checks that are outstanding and what your accounts payable is. And you can start to look at that on a, you know, you can go out 2 weeks before you get, you know, really still pretty simple cash flow analysis. Okay, on Friday, I got payroll. I can put that expense in. On, you know, Monday next week, rent is due. I can start to put that expense. Because a lot of people get overwhelmed and think about, oh my goodness, what is a cash flow statement? How do I put this thing together? And it's so complicated. It can be very simple to start with. It's just a matter of how much cash you have, plus your available line of credit, minus your upcoming expenses, to give you a little bit of warning as to where you're at and what you can do before you get there.
To tag on to what Jamie said a little bit earlier is to have that credit line in place. If we wouldn't have had that when that Great Recession hit, and we had a pretty healthy credit line, even though we were using just a small portion of it, it really did save us at that time.
Jamie, on top of this 13-week cash flow, or making sure you have 3 months of expenses, is there anything else a retailer can do to develop a long-term financial plan to kind of look at stability and growth for the future?
We'd like to look at again, we try to keep things very simple. A lot of the retailers struggle with some of the financial ratios and financial terms and so forth. So from a financial plan, we like to start really, really basic. Have a 3-line P&L. you have your margin percent, whatever, what your general margin percent is. Let's say it's 50%. Margin is what you normally get. And then you calculate all your expenses. So take your current P&L year to date, add all the expenses, payroll, rent, taxes, everything, and calculate that as a percentage of your sales. So now I've got 50% margin and I've got, let's say, 48% expenses. So I got margin percent, expenses percent, and then if you subtract those two, that's your net income. So I got 50% minus 48 equals 2% net income. So if you're not happy with that, or if you want to target, let's say 5% into the year net income, you've got to change either your margin percent or your expenses in order to get to that 5%. So very simply, if I just grow my margin by 3 points, then now I have 53% margin minus 48% expenses. Now I got my 5% net income. You can do that, or you stick with your 50% margin and you take 3% of your expenses out, or you do some combination of both. But that very simple analysis makes it very easy to understand. Okay, I'm going to grow my margin 2%. That's going to take care of most of it, but I got to cut expenses by 1 in order to get to that 5% target.
I'm going to tack on to that one. We talk about, first off, we always do a break-even analysis. And one of the things you have to watch out for in the break-even analysis, especially if you're carrying any debt as a business, is that when you look at your profit and loss statement and you look at if your profit and loss statement is working the, sort of the generally accepted accounting principles are, the problem with just looking at the profit and loss statement and not really looking at the face of the loan is that what shows up on your profit and loss is the interest expense, but not the principal payment that happens there. And people sometimes miss that in their break-even analysis, and then suddenly, why isn't it working? It's because you didn't consider the principal. But I think, the other thing is that, do you ever notice, like when you're buying airline tickets, it's never $400. It's always $400.91 or something like that, right? Delta figured out years ago that just by doing that, right, they actually picked, and by adding the pennies to every single flight that they do, they picked up something like $5 million in pure revenue just by putting the pennies on there. I think pricing structure, and it's important to understand both pricing structure and pricing psychology to wring out some of that extra dollars that make it different in the bottom line. We spend a lot of time working on that. And I think the other concept that you have to understand is this concept of cash margin, right? Cash margin is your sales at retail minus your receiving at cost. Now, why do we look at that? We look at that because, I could buy something for $10 and sell it for 20. But what if I sold one, but I bought 30? From a cash perspective, I'd be upside down, right? So we're constantly measuring the cash margin to make sure there isn't a cash flow to sustain the business and make it happen. But a really solid understanding of the expense structure is everything in terms of planning your margins, planning your sales, and planning your inventory levels to get good cash flow out of the business. And that's not a small exercise. It's not a small feat.
Ronnie, did you have anything you wanted to add on top of that?
No, I'm good there.
Okay. So staying on this topic of looking at financial metrics, I've heard you guys talk about break-even analysis, margin as a percent of expenses, expense percentage, cash margin, and net income. What other KPIs should retailers be looking at?
I would say, well, I talked about turn in the beginning, and I think turn is an enormously important one. Gross margin return on investment is another one. That one, just to clarify that a bit, it's your gross margin, your profit, divided by your average inventory at cost. And if you think about it, it's what am I making divided by what my investment is. And if you're really measuring gross margin return on investment well, you can see, okay, here's my profit, here's my average investment in inventory. And if I want to improve the business, it's either improving my margin, my profit, or lowering my inventory investment. And I can't think of better drivers to do it than those two. So I'm heavily focused on turn and gross margin return on investment, and cash margin too. But cash margin is just a function of GMROI.
Dan, what's a viable turn rate?
You know, it's going to be different based on each category within the store. Okay. But I would tell you this, and you know, today an average store, you know, an average retail store, and you can debate this, and we kind of, and in my world, we debate it all the time. But you know, you have to start as a base of at least 2.5. You should at least turn 2.5 times a year, and you want to turn faster than that. But any store turning less than 2.5 times a year is going to have significant
English.
cash flow problems.
Ronnie, Jamie, are you
And
guys in agreement of that 2.5 mark being kind of that minimal number?
Yeah, depending on, there is some confusion when we calculate turns. So if you're looking at cost of goods sold over your inventory, then yeah, that 2.5 turns. If you calculate your turns with sales divided by inventory, then it's closer to 5. But yes, that general number is a good target. It is a little bit lower since COVID for most retailers, but that's a very good target for an industry.
I would agree that 2.5 would be a good starting point only.
Yeah, it's the baseline. I wouldn't, anybody
Sure.
less than 2.5 is going to really have a hard time. And certainly 5, if we're talking about things like custom, it can go even faster than that, you know, if you're a heavy custom business. But you have to look at it on a class by class or category by category basis. You cannot, you can't homogenize that number, because if you're a furniture store, but you also carry some home decor items that are in there as well, those should turn faster. That generates more cash, that support the fact that I don't sell a couch every single day, you know.
But back to one of your earlier question of really where do we, to grow cash flow, we got to cut expenses. Where do you cut, and what is your priority there? Is, you know, we like to, in some of the metrics we like to look at, we do like to look at payroll as a percent of margin dollars. And because it really gives you a different viewpoint. So if you take your total payroll and you divide it by your margin dollars, for this industry, it's usually going to range anywhere between 45% and 55%. So just assume that we're in the middle for a minute at 50%. It means every dollar of margin that you collect, 50 cents of it's going directly to your payroll. So that's by far, you know, one of your largest expense, because then you got 50 cents left to cover all your rent, your utilities, your taxes, you know, all those other expenses, advertising and so forth. So looking at your payroll is usually one of the biggest targets to reduce costs. And, you know, a lot of times retailers debate, so how many people do I really need to run this business? And we believe that a good target right now is if you take that every employee that you have should be able to generate $300,000 in sales. So if you just take your total sales divided by your total number of employees, whatever that number is probably going to be anywhere between 200,000 and 350,000 generally. You got to target about 300,000. And so what that means, if so let's just say we have a $3 million business and we have 10 employees, you take that $3 million in sales divided by 10 employees equals this target of $300,000 per employee. So that gives you an idea as to whether you're overstaffed or understaffed. So, and you can just take a multiply that. So if you're not a $3 million store, if you're a $6 million store, it means you ought to have about 20 employees. And if you're a $9 million store, you ought to have about 30. So that's just kind of the way that works. And that gives you a good target to understand whether or not you're overstaffed or understaffed.
I have a slightly different metric by which we do it, but that's why there's 3 of us on the call, because there's not one way to do it, right? We usually take what we're paying them, and I'm not counting benefits, I'm not counting taxes, just purely what we're paying them, and divide that into sales. That becomes our selling cost as a percentage of sales, right? And you know, depending on where you are in the country, it could be anywhere as low as 9%, it can be as high as 18 or 19%, depending if you're in a super urban area. But we always tell people, look at that to start with. And then number 2 is, what if you could improve that by maybe 2%? Like if your selling cost today was 12% and you can get it down to 10%, what does that mean, right? It does definitely suggest it does definitely suggest, you know, the right staffing numbers like Jamie was suggesting, but it also might suggest like, okay, well, what do these guys actually have to sell? And am I training that? You know, the other thing I find is that a lot of these people, a lot of salespeople on the floor are not trained well enough to get to the kind of sales numbers we need them to get to. A lot of times it's like, you know, if I'm hired and Ronnie's on the floor right now, people say, okay, well, just follow Ronnie around. He'll tell you what to do, right? And then I pick up all of Ronnie's bad habits, and you can clock in 15 minutes late, doesn't really matter. All that kind of thing, right? I find that not enough time is spent on getting them enough product knowledge and enough add-on knowledge so that when I come across the threshold to buy a chair, that someone shows me enough other things that I end up buying the whole living room, right? So I think another way that you improve upon your selling costs, whether you do it as a percentage of sales like I do or percentage of margin like Jamie suggested, either way, it's units per transaction and average dollar sale, which is the other metric I think I would look at in this thing to evaluate whether or not my salespeople are doing the job that I want them to do and actually getting the most out of each individual sale.
Yeah, so Dan, we used to call that training method. I learned it from the last guy who learned it from the old guy who learned it from the dead guy. And so one thing we used to try to do to help employees help you manage your cash flow, because I guarantee you your employees, management doesn't understand it most of the time. The employees have no clue. If you were to ask your employees, if I sold, if we sell $1,000, how much does a company actually keep at the end of all expenses after taxes? And I can tell you that they will, the lowest numbers you're ever going to get is going to be, $300, $400. They don't understand that you're only going to keep $50, let's say. So we used to do a couple of things. Well, first we used to, and it wasn't my idea, I don't remember where I heard it from. Every couple of years, we would take $1,001 bills into a management meeting and say, okay, here's $1,000, and ask everybody what they thought we kept. We'd post that. And then we'd go through the exercise. Okay, here's the merchandise cost. Here's the labor cost. Here's this. And you can just see their eyes just kind of opening up as that bundle of money kind of dwindles down to $40 or $50 when it's all said and done. And then we tried to instill in them that, okay, so now you understand that it's only 5% or 50 cents. So the other way to think about it is, if we can do something to save $500, it's the equivalent of selling another $10,000. Then it starts to kind of make some sense in their minds, and then the training starts is, okay, what can you do to help us? Because believe me, they see more things than what you're seeing. You're seeing things on the top level. The management doesn't see everything that's going on the floors. And we got some pretty great suggestions and some pretty, neat things. We really try to get them to come in and saying, okay, when you walk in the door every day, what can you do to either, create more revenue or save on expenses when you walk into the stores?
Most employees think that all ideas have to come from management.
Yes.
Right. And they also think, to your point, that every time I sell a $10,000 piece of furniture that I got $9,950, right? They don't understand that what happens there. But I like, for example, I've been telling we tell a lot of our folks to do things like, when we have our next staff meeting, each of you need to come with an idea for an event we could do inside the store. And when you say stuff like that, you're going to hear this creaking sound, and it's the creaking sound of wheels turning that have not turned in a long time in their minds, where they actually have to think for the first time. And so, encouraging them to think and be part of the solution, and have some skin in the game and have some understanding of the business is such an important strategy for owning a store. Some store owners feel like, oh, well, I don't want them to know my numbers and stuff like that, and that kind of thing. The opposite is true. The more you actually share with them, the more opportunity you have for them to come up with clever ideas. And also, the less time people are going to come to you and say, listen, I think I deserve a 30% increase in sales, in my a 30% increase in my salary, because we're making all this money. That, you know what I mean? I find that the more they understand it, the more they can contribute and help you not feel like you're so alone as an independent retailer.
I know we're winding down on time, but there's one issue that we didn't talk about today, and it's just about leveraging debt. Some of the retailers that are attending have extra cash on hand that's not needed for operations. Some are debt-free. Some are leveraging debt as a cash flow strategy. Can you talk about the pros and cons of both? Is there a preferred method? How do you leverage debt in your cash flow strategy?
Sure. So, I always think that it's best to invest in what's going to bring a return. So I know that you've got a lot of people operating with some really old software systems out there right now, and there's so much out there that can really help you not only improve business but become more efficient and improve cash flow. And basically cash flow is you're either generating or creating a negative in almost everything we do in the business today. So if you can get things that will help drive your employees to do what you want them to do and give them the information to work with, I think it just trickles all the way through in every aspect of the business and in helping, generate better cash flow.
I guess I would say this, it's hard to sort of generally say, to speak to leveraging debt. You have to look at each individual situation. What are the terms of the debt? How does it work? Obviously, if you can leverage your own cash, like Jamie suggested before about having 3 months of expenses in the bank, to the degree that you can actually, stockpile enough cash that you can leverage your own cash as opposed to leveraging debt, that's going to be the least expensive way to do it. I think the most important thing, though, when you talk about cash flow in all of this thing is, I find that most buyers and a lot of store owners really understand how to, put a room together. They understand the art of the business, not necessarily the science of the business.
Right.
And if you are that person that, I could put together a room beautifully. I know what goes with what. I'm sitting here in my living room and now I'm embarrassed because some of you guys will probably go like, God, what's he doing in that chair? But anyway, that said, if you're the art of the business and you're not the science of the business, no different than you would say to someone, look, if you don't know how to design your house, don't do it alone, get a designer. If you don't understand cash flow, get someone who understands cash flow. And it's not your CPA, by the way, because your CPA is an accountant. Their job is to help you do better with your taxes and minimize your expenses. But they are not about cash flow a lot of times, and they are not about maximizing the business, and they're not about maximizing your margins, except to say just do better. But you need people that are actual retail experts in that to help you do that and make that work. And so I think, if you're the art of the business, reach out to people that are the science of the business and are the science of retail specifically to help you plan and make that work.
Yeah, and I guess I would say in terms of leveraging debt, I mean, obviously, if we could all grow and finance it by our bank account, that would be fantastic. But most of the time, that if you're growing, if you're adding locations, that you're going to have to take on some debt to do that. And then it becomes very critical that you don't over leverage yourself to where you can't weather a small storm in volume or a small hiccup. So you've really got to look at that cash flow and understand where that comes into play. And as you know, a lot of times that comes when you're adding a location. And there are some unique strategies that you can take to help minimize your risk when you're adding a new location. Just for example, adding a new location is a great thing for your vendors also. And a lot of times you can get extended terms on those floor sample inventories. We've worked with some vendors and we've gotten up to 365 days of payment terms on floor samples for a new store. They want you to succeed as well, and they know it's expensive and it's difficult to get a new store off the ground from a financing standpoint. So there are some creative things you can do to not only leverage the debt, but also leverage other people's money, like vendors as well as your customers, by collecting up front.
We've had some vendors actually that also contributed to the build outs of the stores.
Yes.
So I wouldn't be shy about asking, hey, I'm adding a new location. What do you want to contribute to, and obviously they get something for that, right? They get maybe some featured stuff about their brand in the store or something like that. But a lot of times they have budget for that. And the people that get it are the people that ask for it.
As well as discounted or free floor samples.
Yep.
Yes.
Absolutely.
Well, guys, I really appreciate some of the insight that you've given us. What came through very clear: collect faster, pay it slower. Inventory is not wine and cheese. It does not get better in age. So the 3 big expenses of your business, get rid of inventory, which is the fastest, and then labor and marketing, which take a lot more investment and are a lot slower. If you're going to measure, look at cash flow forecast, margin percentage, expense percentage, What else we got? GMROI, turn percentage, net income. And what I heard is a great takeaway: empower your people, help them understand the business and recognize that what they think looks like the actual net income, or the truly the net income of the business, may not be actually as it seems. And so great takeaways. I really want to thank you, Dan, Ronnie, Jamie. Thank you guys all for attending. Just a reminder to everyone watching that our webinars are available on demand, myhfa.org/webinar. There's so much valuable information. We'll try to recap some of this, but please rewatch this to get some of those great formulas. As Dan also shared, they do a 13-week free forecast with the retail smart guys. And please tune in 2 weeks when we do our next webinar, part 2, which is maximizing revenue streams and strategic growth. I hope everyone has a great rest of your week, great sales, and we'll see you soon.
Thank you.
Hi, everybody. Thank you so much.
Thank you.